Now let's talk about the disadvantages of sole proprietorship. A major drawback is unlimited liability. A sole proprietor is personally liable for all the debts incurred by the business. If it fails to generate enough cash, bills must be paid out of the owner's pocket. Another disadvantage is lack of continuity. A sole proprietorship legally dissolves when the owner dies. All the business can be reorganized by a successor, or the executor or heirs must otherwise sell the assets. Finally, a sole proprietorship depends on the sources of one person, whose managerial and financial limitations may constrain a business. Sole proprietorship often finds it hard to borrow money to start up or expand. Many bankers fear that they won't be able to recover the loans if owners become disabled or insolvent. Partnership. As we talk about partnerships, they are very popular. The partnership is frequently used by professionals. The most common type of the partnership is that of the general partnership. It is a sole proprietorship multiplied by the number of partners, the number of owners in a firm. There is no legal limit to the number of partners, but the average is slightly under 10. Partners may invest equal or unequal sums of money, and they can have their own financial investment in a two-person partnership, receive 50% each, or they can have the more, and then they receive the profits according to their investment and the skills and expertise that they have for the same business. There are advantages and disadvantages of partnership as well, as we had it for the case of sole proprietorship. Let's talk about the advantages of the partnership. The most striking advantage of general partnership is the ability to grow by adding new talent and money, because banks prefer to make loans to the enterprises that are not dependent on a single individual. Partnership finds it easier to draw loans from the bank as compared to the sole proprietorship. They can also invite new partners to join by investing money. So they always have their doors open for the refinancing of a firm. Like a sole proprietorship, a partnership can also be organized by meeting only a few legal requirements. Even so, all partnerships must begin with an agreement of some kind. In all but 2 states, the revised Uniform Limited Partnership Act requires the filing of a specific information about the business and its partners. Well, partners may also agree to bind themselves in ways not specified by law. In any case, an agreement should answer questions such as, well, the questions are, who invested what sums? The next question, who will receive what share of the profits? The third one is, who does what? Talk about the responsibilities. And who reports to whom? And then, how many partnership? The next question is, how may the partnership be dissolved? In the event of dissolution, how will the assets be distributed? And last but not the least, how will surviving partners be protected from claims made by a deceased partner's heirs? Well, these are some very basic questions, and they are answered, and such an answer is in fact an agreement among the partners or between the partners. The partnership agreement is strictly a private document. No laws require partners to file agreements with any government agency, nor are the partnerships regarded as legal entities. In the eyes of the law, the partnership is just 2 or more people working together. Because partnerships have no independent legal standing, the Internal Revenue Service, IRS, taxes partners as individuals. And there are disadvantages of partnership as well. We can discuss the disadvantages of the partnership in our next video, and this is where I'll assume some of the damages that we can have under the umbrella of partnership.